What's up everybody, Nate here. And over the last couple of years, the housing market has been riding high. We have seen prices pretty much set a new record month after month after month. And there was this explosion of demand in the market with pretty much everybody and their mother wanting to buy a house. But then 2022 happened. All of a sudden, investors and experts were talking about how the housing market could eventually crash and prices and inventory and everything else started to drop pretty significantly. But now we're into 2023 and the housing market hasn't crashed yet. And what a lot of people are wondering right now is the housing market going to crash in 2023 and beyond? Well, that is exactly what we're going to be talking about today. So if you like this video, make sure to hit the like button below. And if you like me and want to see more videos from me, go ahead and hit that subscribe button too. Now let's sort of break down the word crash here. And no, this isn't a spelling bee and it's not a grammar test. When we talk about crashes in the business and financial world, well, the first thing that you need to understand is that crashes typically come in cycles. Our entire economy and pretty much every single market that has ever existed goes through a wave of big booms and then big busts. Like I said, you can see this in pretty much every industry. You can see this in pretty much every market. You can see this throughout our entire economy with recessions and stock market crashes. Now, the second thing that you need to understand here is that crashes, well, they're always different. They are always different and unique because the factors that cause them are also very different. For instance, what is going on in the housing market right now is very much different than what happened in the housing market during the 2007-2008 housing market crash. Just like what happened with the 2020 stock market crash is very much different than what happened during, say, the 2001 dot-com bubble that essentially crashed the stock market. And the third thing is, what exactly is a crash? Well, when we talk about a crash, that means something completely different depending on the industry and the market. When we talk about the stock market and we talk about the housing market, we particularly look at one key factor, and that's housing prices. And when housing prices typically go down by around 20% very quickly, well, that could be considered a housing market crash. Now, for the stock market, this is something extremely easy to measure because you're looking at asset prices that are stocks, and you can pretty much look at the averages and tell our stock prices going down by around 20% on average. So it's really cut and dry and very easy to see. But the housing market is very much different because we have pockets of really successful housing markets and some really not successful housing markets all throughout the United States. Right now in particular, there are housing markets that are still exploding. Meanwhile, there are other markets where it is definitely a buyer's market and it is time for sellers to really start dropping the prices down in order to be competitive. So a crash in the housing market is very much different than, say, a crash in the stock market. But I want to talk about why we have not seen a general nationwide crash in the housing market like we saw during the 2007-2008 housing market crash. Well, the first thing has to do with inventory. Now, inventory in the United States for the housing market has been extremely low over the last couple of years as there's just been this really heightened demand for houses. At one point during the height of the pandemic and the height of this sort of housing market boom back in 2021, it was pretty much 10 to 1. There were around 10 buyers per every one house. That is part of the reason why prices got out of control, because buyers were having to go through bidding wars in order to get homes. If the list price was around $200,000, well, somebody would put $210 down just to be competitive, and then somebody else would put $215 down, and then $220 down, and all of a sudden your house is worth $250,000. That was not uncommon. There were some listings even around my house that ended up going for around $50,000 or more above asking price. And this was pretty common all throughout the country. So prices went up, but the amount of people that are continuing to put their house on the market is dramatically going down. Part of the reason for that is because people, especially first-time home buyers who bought their house over the last couple of years, well, they are not selling their house. Typically, when you have a first-time home buyer, they want to stay in their house for around 3 to 5 years. They want to kind of figure out how to manage a house, the expenses that go along with it, and if they're ready to buy a new house, then they're going to upgrade. Typically, that means they have a life change, like they get a bigger and better job, or they have a kid, something along those lines, that they need more space, they need a different home. But like I said, that is just not happening right now pretty much across the board. So you have a lot of first-time home buyers who are staying in their home a little bit longer because of one thing: interest rates. Mortgage interest rates in the United States are around 7% right now for a 30-year fixed mortgage, when just a couple years ago, the average was around 2 to 3%. So now they have more than doubled, which means the costs of owning a home have also doubled. Many people just don't want to get into a new home. Why would they? They don't want to pay any more than they have to, especially in this slowing economy, especially if they don't know if their job is going to be stable because the economy is slowing and inflation is still highly elevated. So they are staying put. They do not want to put their house on the market. But that is just new home buyers. Why exactly is the rest of the market not putting their house on the market either? Well, to understand this, you have to know about a concept called equity, and millions of homeowners have got a lot of equity in their house right now. Equity is basically the difference between what you owe on your mortgage and what you've already paid off. And you want a lot of equity in your house because if you were to sell your home, then you can make more money off of it. Versus if you were to buy a house and then sell it the next day, well, you would basically break even because it would be worth the same exact amount. You wouldn't have anything in it, so that means when you go to sell it, you're not going to be getting any money out of it. Well, equity is really interesting because Americans have a lot more equity in their houses right now because the value of their homes have gone up pretty significantly. So if you were to take out a mortgage for say $200,000 and today your home is worth around $250,000, well, that means you have around $50,000 in equity in your home. So when you sell your home, you're going to be able to pay off your entire mortgage and be left over with $50,000. Many Americans who were sitting on 30-year fixed mortgages and they were on year 15 or year 20 and they had already paid off 50% of their mortgage, well, now they just had a huge spike in equity. So their home is worth a whole lot more now, and because of market conditions, they kind of want to ride out and see how things go. And the fact of the matter is, if they sell their house, well, they have to have somewhere to go, right? So with really high prices mixed with really high interest rates, well, that means that getting into a new home is just going to cost them a whole lot more. So they would rather stay put with all of this equity. Not to mention, there also is a lot of fear out there because people have been talking a lot about a housing market crash and potentially prices going down very quickly. Well, you don't want to put your house on the market and then eventually lose money on it. That would mean you're essentially underwater on your mortgage. So that's basically the opposite of equity, right? Because now when you go to sell your home, you don't have enough to pay off your mortgage. So now you need additional funds in order to do that. So if that was the case in the previous example, if you bought your house for say $200,000, today it might be worth only $190,000, which means you have to find the $10K difference. We talked about buyers and we've talked about sellers, but there is one more key to the puzzle here, and that is home builders. Home building essentially exploded during the peak of the pandemic because there was so much demand in the market and prices hadn't really gotten out of control as of yet. So there were millions of people buying houses, which means there was a market for real estate investors and home builders to create all of these homes and then fill them very quickly because there was so much demand for houses in general. People would take whatever was out there. But what you've got to remember here is that houses take a long time to build. It's not an overnight project. It can take months to build a home, which means home builders kind of have to anticipate what demand is going to look like 3, 6, and 9 months from now. They're anticipating that home demand is still going to be very low, which means inventory is going to remain low because sellers aren't putting their house on the market and there isn't any new homes that are being created in mass. The reason being is because the materials to build a home and the interest rates to actually borrow money to build that home are extremely high right now. So if a builder builds a house and nobody is on the market to buy it, well, now the builder has a home that nobody wants and they still have to pay the bills on it. So they are completely pausing on their building. They don't want to build new homes because they don't want to be stuck with the debt, meaning the housing market is going to continue to have low inventory. And now that you know all that, we can finally answer the question, is there going to be a housing market crash? Well, unlike a lot of the experts and investors out there, I can firmly say that nobody truly knows if there is going to be a housing market crash or not, especially me. In order for there to be a crash in the housing market, well, we have to see prices significantly drop all at once. And the only way that prices would be able to significantly drop is that if demand was basically non-existent and then supply continued to go up. that would mean that there are more houses on the market than people want to buy. So in order to get those homes sold, prices have to come down. But the really strange thing that we're seeing right now is that even though interest rates are high, there are still people out there who are purchasing homes, meaning that demand is still just slightly higher than what supply is. And as long as that's the case, you can't really see a crash in the housing market. But again, that could completely change. The Federal Reserve has been raising their interest rates to combat inflation because when the pandemic started, the Federal Reserve printed a lot of money. The federal government had a lot of stimulus programs. That meant spending was at an all-time high. And when you have all of that spending and all that extra money in your economy and you have all of that demand, you're going to have really elevated inflation because everybody is buying at an unprecedented rate. So the Federal Reserve wants to eliminate that demand by making it harder to borrow money, which is why their interest rates are higher. With their interest rates being higher, well, that means it's harder for banks to borrow money too. So they raise their interest rates. They make it harder for you to use their money. And with interest rates in the housing market sitting at around 7% on average right now, well, that means that millions of Americans are pretty much disqualified from getting a mortgage altogether. So demand is definitely coming down. And like I said before, we are seeing pockets all throughout the United States where prices are declining. But we started 2020 with around $3 trillion in circulation, and today we have over 20 trillion. So there is so much money out there, and that means there are still people spending money. Saving rates hit an all-time high in 2021. Americans put a lot of money away, and now with inflation staying high and the economy slowing, people are starting to go through that cash. They're starting to spend it, which is why inflation has stayed high. So that's part of the reason why people have continued to buy homes even though interest rates are going up. But like I said before, eventually interest rates could get extremely high, like what we saw during the 1980s during the last crazy inflation spike. This was during a time when inflation was 10 to 12% plus, so the Federal Reserve raised interest rates to 10 to 15%. It was really, really difficult for people to buy a house. Now you gotta remember though, prices during that time for homes were very much lower than what they are today, but still the situation remains. People who have the money, people who are in a good financial situation, they're going to continue to spend money. But overall, if the Federal Reserve continues to raise interest rates higher and higher and higher, well, that means there's not going to be any activity in the market, and that could potentially cause a crash. Before 2022, we also had really low interest rates, which helped a lot of that demand as well. So the exact opposite thing could happen if the Federal Reserve was to lower its interest rates at some point. Well, that could mean a lot of Americans suddenly qualify for a bigger mortgage and they go out and buy houses. That could trigger home builders to make a lot more homes. That could trigger sellers to put their house on the market because now they can cash in a lot of that equity. So like I said, a lot of things are up in the air right now, and it really just depends on what is going to happen in the future. So why exactly are all of these publications and investors and experts saying and sounding the alarm that a housing market crash is going to happen? Well, this is why you need to be financially educated and you need to stay up to date with everything that's happening in the business and financial world, because this type of rhetoric happens all the time. A lot of these investors, well, they have skin in the game, right? They have investments. They are real estate investors. They want you to go out and buy a house. They want prices to go down so they can buy more. The same with companies like Realtor.com and Zillow. All of these different companies, well, they have skin in the game because they literally sell houses. So of course they want people to have that fear of missing out. I better get a house right now. I better sell my house right now because that is good for their business. But the other thing that you need to consider here when it comes to news publications and when it comes to influencers online is they are going to feed you whatever is going to get them the most amount of views. That is how news organizations on TV and on the internet have worked for years now. So they have sort of this doom and gloom mentality. They want to give you this big crazy headline that housing prices are going to go down by 20% or more sometime soon because that is scary and it triggers an emotional response. As a consumer, as an American, as an investor, you kind of have to see through all of that and you have to be able to translate all of these facts and figures and know where you're getting your information from. That's why it's extremely important to know who you're talking to and why they're saying something. And more importantly, you have to know what to do with all of this information. Financial education will allow you to do all of that because now you can figure out exactly what to do with your money. You'll know how to sort of capture a lot of the opportunities that are coming forward, and you'll know what to do with your money in case things start to collapse. But you'll never know that if you're continuously listening to random people on the internet, like me, or random news outlets. But enough about what I think. Now I want to know what you think about the housing market in 2023. Do you think that we're on the cusp of a crash here, or do you think that the housing market is actually going to boom at the end of 2023 into 2024? Let me know your thoughts in the comments below, and if you're ready for more business and financial news, I've got another video ready for you right there, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.